Okay, this is going to be a quick video. This is actually a little bit of a warning sign. If you want to invest into Sarasota real estate or Florida real estate for that matter, or if you're thinking about purchasing here, some of these hints also might help you because a lot of these points are not talked about, especially by people like me, real estate agents, because a lot of agents just want to make the sale, get the money, and move on to the next sale. But I'm the type of guy that's going to give you the 100% warning on what you should watch out for. And by the way, my name is Machek Zera. I'm a real estate agent in Sarasota, Florida. If you're thinking about investing or buying or selling or anything to do with real estate, let me know. Reach out to me. All my contact info is below. And right now I am at Nathan Benderson Park over in, it's on the edge of Sarasota County and Manatee County. I do believe it's in Sarasota County officially, which is right behind me where all the rowing competitions happen, all the regattas happen. So we're going to talk about 4 points. Let me get right into it. Point number one is about insurance. Let me tell you what you can do to try to prepare yourself to have the lowest insurance possible. And in general, on a single family home, the lowest insurance you're going to get for a median price home, which is right around $450,000, is going to be somewhere around $2,500. That's going to be the absolute lowest, and that's usually, you know, with all the wind mitigation credits that you can get, even if you get a smaller brand new construction, which gets every credit you can possibly get, then you're going to be somewhere right around the 2,500 range as well. The reason why it's going to be 2,500 because a lot of insurance companies, a lot of carriers, they have what they call the minimum required premium. If your home qualifies for a lot of discounts just in general because of the year of construction, then you're not going to get that much of a discount when it comes to your wind mitigation credits because you're already on the lower end of the the premium price. So to save money on insurance, the first and foremost important thing is actually the age of the dwelling. And the reason it's the age of the dwelling, and by the way, that is the oldest dwelling on the building because you might have two single family homes on one parcel of land in some cases. Well, you want to have something that is less than 20 years old, ideally less than 15 years old, because it meets a lot of building codes. You're going to get a lot of discounts because it's, quite frankly, low risk to the insurance company. But if you have to go into some of these older homes, then I would recommend maybe watching the video I just did a couple days ago about how to lower your insurance premium. It's a longer video going into detail about what I'm talking about. Obviously, age of the dwelling is the number one most important thing. Second is, if you're going to go into the older ones, make sure the roof is less than 15 years old. Ideally, less than 10 years old. Not 10 years or less, but less than 10 years old, because there's a lot of insurance companies who are not writing new policies for homes that are over, where the roof is over 10 years old, 10 years or older. So just make sure that the roof is done right. And while you're at it, you might as well double check. Does it have 8D nails for the roof decking? Also, does it have a secondary water barrier that is a peel and stick as opposed to the felt underlayment? You know, that's the SWR. You want to just make sure that you're getting as many discounts as you can get, but the most important discount are what they call clips. So basically, if you have the wall to truss attachment being just 2 nails, even if there is a clip, that's considered just toenails. But if you can make sure you get 3 nails in there, so you can't actually hire a company to do that, the third nail guy locally here, then you're going to get some big discounts as well. Now, sometimes when you're already on the lower end of the minimum required premium, then that discount is not going to be a lot. But if you're not, you might get a huge discount. I had a huge discount doing this to one of my properties. Now, the other thing with insurance, obviously, just double check what flood zone it's in. X flood zone or X500 does not require flood insurance because it's a low risk. And then if you choose to get flood insurance, it's just going to be cheap. So don't get blindsided by the high insurance rates, because you can take some steps actively ahead of time prior to even looking at the property, double checking based on what year it is and what some of the age of the roof and a few other things, which is all public information, you can check the permits on that, then you don't have to waste your time if you see the roof is 16 years old, and that's definitely going to cause you to have a pretty high insurance rate. Listen, you need to get with an agent that's going to do a lot of work for you, and unfortunately most agents just open doors. So if you want someone that's professional, even if it's not in my area, I do help people up to 3 hours away from here, which is pretty much half of the state. Okay, so the second thing that you have to watch out for are the property taxes. Now, what you're going to see when you're looking at listings and properties is a disclosure on how much property taxes are. It's just something you can check on the tax assessor's office within the county that you're in. You can check every single parcel of land how much the taxes are, but the part where people get screwed, there's actually two things that happen. First is new construction. This one's easy to explain. It's like this. It's vacant land, so they're paying property taxes on vacant land, and then it gets constructed. Now the property taxes go up drastically, significantly, and you have no idea how much they're going to be, unless of course you have a good agent that can calculate that, and that's multiplying the millage rate with the approximate value of the land and the improvements on the land. So anyone who knows how to do some math, multiplication and then addition, can do that for you, but no agent's going to do that except for me. So if you want to know what's going on and how to calculate that, let me know. But that is the easy one to explain. Basically, how much is the property tax going to be if you have a new construction home? Because people, once again, get blindsided. They see, ooh, $600 property taxes. Well, it's not going to be $600. That's the property taxes on the vacant land, and it's just not going to be that. So the other example of property taxes is if you see that the homestead exemption has been in place. Now you actually have to dig deeper. The MLS will not show you how many years of homestead exemption that parcel has, but as a public information, you can go into the tax assessor's office for the county and you can check how many years have been the current owners have had the homestead exemption, and from that you can basically tell how much of a discount they're getting. I have seen some situations where property taxes doubled and tripled, like no problem, after 6-7 years of ownership and having homestead. The new owner buys it and then their property taxes skyrocket. So how do you calculate that? Once again, it's easy. If you want to know how to do it, just reach out to me. I'll help you figure that out. But know that whatever it is that the millage rate is for that area, you take that number and you multiply it basically by your purchase price. Quite frankly, it's probably going to be about 90% of your purchase price. That's how the tax assessor seems to do it. Every county's a little different, but you can calculate it. And where do you get all that info? It's all public information. So drop me a line and I'll help you figure it out for your particular county. But the bigger problem is when you have a loan and you have homesteaded property that you purchased, or the new construction and you actually have a loan. So what the lender does is interesting. They just take the current property taxes. Let's just say this new construction based on vacant land, $600, and then they divide it by 12, which is what? $50. And they assume your property taxes are going to be $50 a month. So then they are collecting escrow as if it's going to be $50 a month. But the reality comes back, and instead of being $600 a year, it ends up being like $4,000 a year. So now you have an extreme shortage in your escrow account. And not, to add pain to the wound already, what they do is they say, okay, well, listen, we will pay it. That's the favor they're doing you, right? They have a shortage on your escrow. They will pay it for you. But then, that's like 1 year after, right? When the tax bill comes out. But then you have to catch up. So your escrow amount, meaning your monthly payment, goes up drastically. But then on top of that, to make it even worse, is that now they have to start collecting for the next year after that. So they have to make up that difference. They have to start collecting the right amount. So you get hit with, a little bit of pleasure, which is you're paying only $50 a month for the first, year or so of owning that property. Then they do an escrow adjustment, and then it jumps up to, what is that, about $375 a month, right? From $50 to $375. but then they're charging an additional $375. I mean, those are just approximate numbers. It's actually closer to $325. But either way, in this example that I gave you, you end up getting totally screwed, and you're wondering, wait, why didn't anyone tell me that my payment is going to go up? I thought I have a 30-year fixed payment, and the principal and interest is fixed, but insurance and taxes only go up every single year. I mean, have you ever heard of taxes going down? Well, they did in the Great Recession, actually, but that was an anomaly. So if you don't want to get caught in this, find an agent that does the due diligence and explains everything to you in a way that you're going to understand it. And then you might have second thoughts on actually buying. Now, I recommend just go buy anyway, because it's a lot better than to make landlords rich. Although if you're my tenant, please stay renting. So now, if you have any questions about this process, just reach out to me. Once again, I'm offering my help to anyone out there. All my contact info is below. Send me an email, sarasota@sarasota.com, and we can get on the phone, chat real quick, and see if I can help you out somehow. And by the way, if you're investing, the property taxes are going to be going up. You are not exempt. You don't have a homestead exemption when it's a rental. So when you do become an investor, your property taxes will be going up to fair market value every year, and they just have a 10% cap on the assessed value. So sometimes when we have years of extreme growth, like 30% growth of the property values, then you'll benefit in those years, but it'll catch up the following years after that, So at the end of the day, if you're an investor and you're thinking about investing, whether it's a condo or a single family home, just know that the property taxes are going to keep going up every single year, as long as the property values keep going up every single year, which they usually do. Okay, now the third thing that not to get blindsided on is the association fees. And not every property is subject to this, but we have condo association fees, and then we have homeowners association fees, and then we also have CDD fees, the community development district fees. And the good news is that CDD fees usually do not change, and sometimes they even go away. Just Google CDD Florida and then explanation and read about all of that. But let's talk about condo fees. Condo fees are the ones you really need to watch out for. They're the ones that go totally out of control when we have insurance spikes. See, the condo association has to insure all the common elements, and if you're doing some number crunching, trying to see if a particular property is a good investment, then you're taking into account the current fees for the association. But if we have a single hurricane and there's some damage, and then insurance rates go up, just like they did after Hurricane Ian in September 2022, well, you're going to be met with a large spike in your association fees. And now the number crunching changes your return on investment. So don't be getting into condos unless you are less worried about the cash flow, right? Because that's what's really affected, is your cash flow, how much you get every month as association fees go up. But a lot of people invest for speculative appreciation, and that is a good way too, right? Like, over time, real estate goes up, okay? And also over time, your mortgage gets paid down by tenants. So, if you're one of those investors that's more about parking your money somewhere, and you're not as concerned whether you're going to get a 4.5 return cash on cash every year, or if you're going to get an 8.9% return, if you're not that concerned about it because you're looking at the long game of paying down a mortgage, having a tenant pay down your mortgage, and having a property in Florida one day, maybe when you retire, well, then don't worry as much about the condo fees. But if you are just all about cash on cash return and your cash flow, then this is very important to pay attention to. Now, homeowners fees fluctuate a lot less. They don't jump as much because they're not really insuring the buildings. They're insuring the common elements of the buildings, like, for example, your pool house and like the gym and whatever the association may have. So insurance does go up for that, but they're not insuring the actual buildings that you're living in. Those are like usually single family homes in a HOA community, and your insurance is covering that. Okay, now the fourth point and the last point that I have about things to watch out for if you're going to invest into real estate in Florida, and this also does apply to, you know, just your single family residence, your home, you know, if you're going to live there, has to do about refinancing. So there's a saying in real estate, and I absolutely hate this saying. It says, marry the house, date the rate. What they mean by that is buy the house and marry it, okay, and keep it, but then date the rate that you got. Let's just say you buy in May 2024, this month. Well, you're probably going to get a 7.5% interest rate, right? Maybe 7 if you're lucky. And they're saying that you're just dating the rate. You can always refinance without worrying too much and having penalties, okay? Now, this is really where you need to watch out. Does it work out to refinance? Sometimes yes, sometimes it does. But there's some situations where it doesn't. For example, if you put a very small percentage down payment, like let's just say 5% down, or an FHA, 3.5% down, and the property value stays the same, doesn't appreciate, but let's just say 3 years later, the interest rate falls by 1.5% to 6.0%. And you say, oh wow, I can refinance and now I can have a lower payment. Well, good thinking, but you may not work, because when you're doing refinances, which are called rate term refinances, you're not doing a cash out. You're not pulling any money out of it. What they do is they won't usually lend you 95% loan to value. You know, they're going to be looking at somewhere around 80% loan to value. And if the property has not appreciated, if you bought it for $400,000 and it's still worth $400,000, they're only going to lend you 80% of that $400,000. So that amount is $320,000. But when you bought it originally, maybe you did a 5% down, so you did a $380,000 loan. So who's going to cover that extra $60,000 difference? You know, nobody, because no one's going to lend you the money. You can't always refinance out. Now, your debt to income ratio is going to be better, but it doesn't matter. A lot of times, refinancing will not work. Now, where it will work is when you really wait a long time and there is appreciation within your property. So the rule of thumb is this. The more you put down on the purchase price when you purchased it originally, and as long as it doesn't drop in value significantly, the better probability you're going to have of actually being able to do a refinance and changing your interest rate to a lower rate. Because right now, like I said, they're somewhere right around 7.5 or so, and if you're an investor, you're going to be in the 8.5% range, and that's with a 20% down payment. If you're doing a DSCR loan, it's going to be even higher, depending on your credit score and a few other factors. But DSCR loans are amazing. If you're thinking about investing, look up DSCR, which stands for Debt Service Coverage Ratio. It is a unbelievable loan program where you can truly acquire properties over and over and over until you run out of down payment money. It's not based on your credit score as much as it is about the financials of the investment itself. Now, let me just add one more quick thing about investing, okay? A lot of times people are very afraid when there's blood in the streets. And is there any blood in the streets right now? Well, with condos, there kind of is. Is it a bloodbath? Not yet. We haven't had the price drops as big as I'm expecting them to get. So it's not there yet, but I do think we're gonna have big price drops in condos, especially luxury condos. So when is the best time to buy? When there's blood in the streets, when everyone is afraid and they're saying it's still gonna drop more. So, you never know when it's gonna stop dropping, right? Because one change of interest rates creates a big change of consumer behavior where they might buy again. But interest rates are very dependent on the state of the economy, the jobs report, the CPI more so than anything. So you want to be tracking that if you're considering, getting into investing, especially if you're going to buy 2, 3, 4 properties. You want to kind of see what's the trajectory happening with CPI and all of the reports that come out released by the Fed. And as there's more and more bad news, which we've kind of been experiencing, where we keep hearing the Jerome Powell, the Fed chairman, say, hey, we're gonna keep rates higher longer instead of the cuts that we were expecting, right? So as you kind of keep hearing news changes and more bad news and so on, just know that less and less people are eager to get into investing. And really the best time to invest was when you know, in the 80s, when interest rates were 15-16%, right? Nobody was buying then, and everybody who bought then made a killing. I mean, literally, you know, they put 20% down on a property that was valued at 20 cents on the dollar. So they were putting 4 cents on the dollar or 3 cents on the dollar down payment, and just a couple of years later, when the interest rates fell, you know, 5-10 years later, they made a killing. So when you think it's the worst blood on the streets, that's the time to buy.